The most people think the stock market is complicated, but honestly, it's actually so simple to make money. You don't need a PhD in finance or the perfect timing. You just need the right mindset and a long-term strategy. Let me explain. Part 1. Let's start by clearing up the biggest misunderstandings. 7% returns sound too good to be true. A lot of people hear numbers like 7 to 8% per year and immediately think scam or gambling. But that's actually the historical average of the global stock market, backed by more than 100 years of data and after inflation. The S&P 500 alone returned 23.31% in 2024. That's not a guarantee, but it shows. Good returns are real and achievable in the long term. 2. Volatility equals danger? Volatility simply refers to price swings. Markets go up, markets go down, and that's perfectly normal. But volatility is not the same as risk. True risk is locking in losses by selling in a panic or never investing in the first place. Over time, price fluctuations tend to smooth out and the market marches upward, so volatility has minimal impact on your long-term results. The real threat isn't volatility, it's missing the market's best days. Even if you bought an ETF at its absolute worst moment, staying invested means you'd still capture the bulk of returns. As the chart shows, the S&P 500's historical annual return of 7.8% falls to 4.1% if you miss the 10 best days, 1.7% without the top 20, and actually turns negative, negative 0.4% and negative 2.3% if you miss the top 30 or 40 days. Since many of the biggest one-day gains come right after major sell-offs, trying to time the market often means sitting out these powerful rebounds, drastically slashing your long-term performance. 3. I can't start small. This is simply not true. Even $50 a month can turn into a six-figure portfolio if you invest consistently over decades. Let's say you invest $50 per month from age 25 to 67. That's around $25,000 total. With an 8% return after inflation, that could grow to over $175,000. That's real money, and it can significantly boost your retirement power. If you look at this simple chart, the basic formula for wealth building becomes clear. Income minus spendings equals investments. You can only reduce your spendings to a certain point. Similarly, the returns you can expect from your investments, typically around 7% to 10% per year, are relatively capped. But your income potential is virtually unlimited, and that's exactly why we focus on growing it. By focusing on increasing your income, whether through career advancement, side hustles, building new skills, or investing in your personal development, you expand the amount you're able to save and invest. And thanks to the power of compound growth, even small increases in your monthly investments can lead to huge differences over the course of decades. In simple terms, the larger the gap between what you earn and what you spend, the faster and greater your wealth can grow. 4. Stocks are gambling. This is a very common misconception. Gambling is based on chance and random outcomes. In contrast, when you buy a stock, you are not placing a bet on luck. You are becoming a shareholder of a company with employees, products, customers, and strategies. Over time, as these companies grow and increase their profits, your share of the company can become more valuable. Of course, not every stock performs well, which is why diversification is key. If you want to reduce risk without having to research individual businesses, index funds like the S&P 500 or MSCI World are a great place to start. These funds give you exposure to hundreds of companies across different sectors and countries, automatically spreading your investment. However, if you enjoy digging deeper, investing in individual stocks can offer even greater returns. When you analyze a company's financials, business model, leadership, and competitive advantages, you can identify strong businesses with long-term growth potential. The truth is, investing becomes more predictable the longer your time horizon is, and the more informed your decisions are. Unlike gambling, success in investing is built on research, discipline, and patience, not luck. So in conclusion, this is how the market works. When you invest in stocks, you're investing in real businesses. And when you invest in index funds, you're investing in a broad group of companies at once, weighted by their market value. We use this to our advantage. Companies innovate, hire people, generate profits, and grow. As a result, the value of those companies and their stock prices tends to rise over time. This is why historically, well-diversified index funds like the S&P 500 have delivered positive returns over the long term. You're not betting on one company, you're betting on global economic growth. And that's proven to be one of the most reliable ways to build wealth. But that's just one simple way to make money. Part 2. Why investing in individual stocks can be advantageous when it comes to investing. Many people stick with index funds or ETFs. And as explained, that's a great starting point. But there are real advantages to picking individual stocks, especially if you're willing to put in the time and research. Benefit 1. More control and flexibility. Investing in individual stocks gives you full control over where your money goes. Instead of buying a broad index, you choose the companies you personally believe in. You can focus on sectors you understand, trends you're passionate about, or business models you trust. This kind of flexibility allows your portfolio to reflect your own convictions. Benefit 2. Potential for higher returns. While index funds are reliable, they reflect the average performance of the market. With individual stocks, you have the chance to do better. By identifying undervalued or fast-growing companies, your returns can outperform the broader market, and sometimes significantly. Of course, this requires effort and risk awareness, but the upside can be highly rewarding. Benefit 3. Transparency. When you own individual stocks, you know exactly what you hold. You can read quarterly reports, analyze financial statements, and track news that directly affects your investments. This gives you clarity and confidence because you understand where your money is and why you chose to invest. Benefit 4. A learning opportunity. Managing your own stock portfolio is one of the best ways to learn. You start to understand how businesses operate, how markets react, how politics can influence the economy, and what makes a great company stand out. And the cool part? All that knowledge doesn't just help you invest better. It can actually help you make smarter decisions in many areas of life. And over time, that knowledge builds up, just like your investments. Conclusion. Start small, think big, and stay consistent. Investing isn't about timing the market or chasing quick wins. It's about building a strong foundation, staying informed, and playing the long game. Whether you start with index funds or dive deeper into individual stocks, the most important step is just start. With patience, discipline, and a growing understanding of how the market works, you're putting yourself in a position to build real, lasting wealth. And remember, you don't need to be perfect, you just need to be consistent. So educate yourself, stay invested, and let compound growth do the rest.